The Singapore Savings Bonds just announced their allocation results, and you can get a max of $10,000 upwards to $10,500. And you see, that was really attractive, right? Because it was yielding 3.21 per annum in terms of interest rates. But then you hear of this recent news of treasury bills or T-bills. It's giving you 4.9% per annum based on the recent 6-month T-bills, which has been the highest interest rate since the 1988, which was more than 30 years ago, when the interest rate back then was a high of 4.73%. So now you may have the question of whether you should put your money into T-bills or SSB. Because you see, previously the hype was all around SSB, right? Giving you like 3% per annum in interest and guaranteed capital. But you see now T-bills has been a very strong competitor, offering you now above 4% of interest, which is already more than the CPF SA. So in today's episode, let me walk you through the differences between SSB and T-bill and whether you should put your money in either of them. And for a little bit of background, right, I did apply for both of them during October, and I put in $10,000 each, which means I applied for $10,000 in SSB, which yielded 3.21%, gotten a full allocation, just nice at 10,000, no more, no less. And I also applied for T-bills, right? I have applied for T-bills before knowing what was the interest rate result. So luckily, it was above 4% as what I predicted it to be. So both of these low-risk investments have been 100% fully allocated without any monies returned to me. But the fact is, this was my first time applying for T-bill. So I guess I could share some beginner pointers if you want to apply for them. And one of the fundamental differences between SSB and T-bill is the interest payment, because you see, T-bills, they pay you the interest upfront. How it works is that your T-bills are issued at a discount based on the issue date and what was the interest result bid. And you see, because I have applied for $10,000 worth of T-bills, and you see, I got a refund of around $209. So this $209 is supposed to be my interest gain from buying this T-bill. And at the end of the 6 months maturity date, I will get back my $10,000 of full value of the T-bill, which means that I have only paid for $9,800 for this $10,000 T-bill, because I've gained back the interest of $200 over as my interest payment upfront, right? So that's how a T-bill works. It will give you back the interest first, and then at the end of the 6 months period, it will just redeem back at 10,000 or par value that you have bought. While the Singapore Savings Bond SSB interest payment is quite different, because it will pay you twice a year, and since it's not paying you upfront, right, you have to wait like at least 6 months from the November issue, which means that the May next year, May 2023, you will receive your first interest payment for your November issue of SSB. So that's for the interest payment, right? How about the interest rates then? Because you see, I've talked about the T-bills hitting as high as 4.19% cut-off yield, which is very attractive, more than the 3.21% by the recent SSB issue, right? You see, the thing about SSB is that you already know the interest rate before you even apply. So you already know that you're going to get 3.21% as announced. I'm not sure what the December issue rate is going to be, but by the time this video comes out, you will have some news about it. And you see, for T-bill, because you don't even know the interest rate beforehand, you have to go through a bid, and in a bid, there is a competitive bid versus a non-competitive bid. A competitive bid allows applicants to specify the yield they are willing to accept, while a non-competitive bid is one where investors only specify the amount that they want to invest, but not the yield. So for normal retail investors, I think don't need to think so much. You all are not institutional investors. Just go for non-competitive bid to make your life easier and to get that guaranteed allocation for T-bill. Now, how about the holding period then? Because you will see that SSB is actually a long-term instrument, whereas your T-bill is more like a short-term bond fund. So there is something fundamentally different between the holding period. Your SSB is for long-term, whereas your T-bill is for short-term. Because if you look at the long-term, although SSB is giving you way lower interest rates at around a 3% range, it is consistently giving you 3% per annum. Whereas if you look at your T-bill, it's only giving you 4% for half a year, which is 6 months. That's really short, right? No one can really guarantee that we will forever be in a high interest environment. That's why SSBs are still very attractive at this current point in time. You are going to get guaranteed of 3% per annum return every year on your SSB. for T-bill, you're only going to get that high interest rate for 6 months. But after 6 months, who knows, the interest rates may be going to cut and fall. So I would say that T-bill is a very good place to store money if you really want to save money for the short term. For example, in like 1 year after or 6 months after, you want to plan for your wedding expenses, your housing expenses, your renovation, all these big ticket items, and you want to save money. You don't want to touch it, you don't want to see it. Then I think the best place to put in is the T-bill, because I think it's backed by the government and the low risk is there, and you don't have to face like market fluctuations if you invest in equities. That's something very different, and it gives a relatively high interest rate as well. 4%, I think, is nothing shabby about it. In fact, it's very good. But you see, some of you are investors and may scoff at the fact that this 3%, 4% interest is just so low, and I'm still young and I want to take more risks. Then why not take a look at the sponsor? You know, there are some really bad news right now because the core inflation in Singapore announced by MAS has risen to 5.1%. But you know, the good news is you can now sign up for Moomoo account using my referral link in the comments, or you can actually scan the QR code right here. And I still can't understand why some of you haven't signed up yet, because once you have deposited $2,700 as your initial deposit, you can get a $40 cashback coupon and also one chance to spin the stock wheel, and you can get up to one free Amazon stock. Now, if you want a really good reason to use Moomoo, you'll be glad to hear that they will be offering 0 commissions for all US stocks and ETFs forever. And at the same time, they're offering 0 platform fees for the first year. And even after the first year, the platform fee is just 0.99 per order. With the Moomoo app, you also get real-time data of the market as well as live prices, you know. And you know that's quite important, right? Because these features in some other brokers are actually chargeable, and Moomoo is giving it to you for free. So hurry up, use my referral link down below or scan the QR code to sign up for your Moomoo account right now. Next up, how about the funding wise? Now, both instruments, both assets, you can use your cash and your SRS to invest in it. Okay, this is the same for SSB and T-bill. You can use cash and SRS. But you see, SSB, you are unable to use your CPF OA to invest in it because they don't allow it. But whereas for T-bill, you can actually use your CPF OA to invest in T-bills. But you see, the thing about investing T-bills with CPF OA is that for CPF OA funding, it is not available through the internet. You have to go to a bank branch for them to actually sign you up for funding through CPF OA. So you think about the time, think about the effort spent going to the bank branch and waiting at the long queues, and at the same time you have to forego your compounding interest effect of the CPF OA, because your CPF OA interest will compound, whereas your T-bill is not compounding. And because you're taking money out of your CPF OA, you'll forego like 1 month of interest, and if you want to put the money back in, it's another month of interest forgone. So I've read some calculations provided by people online that the break-even point is at 2.9% interest if you want to make your CPF OA worthwhile to invest in T-bill. So any T-bill interest above the 2.9% per annum, I think will be a good option if you have the time to queue at the bank. And with T-bill going above 4%, I think it's definitely a very good option for people who want to put their OA investments into higher interest assets like T-bills. But for the cash and SRS funding options for both T-bills and SSBs, that is much easier already, because you can do it through internet banking or even ATM. So I don't think it's much of a hassle if you go through cash or SRS. But CPF OA, then there are more manual steps involved. Lastly, let's talk about the allocation size, because you know that your Singapore savings bond has a limit of $200,000 per person. That is the cap. Okay, you cannot buy any SSB above 200,000, which means that you have to look for other venues to generate high interest or low risk. Then maybe T-bills is the option for you. Maybe you have already maxed out your SSB's allocation of 200,000. Then where is the next place to park the money? Probably T-bill, because I don't think there is any upper limit for applying for T-bill, right? Correct me if I'm wrong in the comments. Quick thoughts about SSB versus T-bill. Which one should you put your money in? I felt that SSB is more of a long-term game, whereas T-bill is more of a short-term 6 months duration thing if you want to park some emergency cash. But you see, also the fact that SSB you can withdraw anytime and get a full allocation of interest, but for T-bills you have to sell the T-bill back in the secondary market, which may be lower than your $1 par value. So you see, there's a little bit of risk here in T-bills, where SSB is always guaranteed at $1. So there's some consideration that you have to go through, whether it's your decision to put your money in T-bill or SSB. And if you want to learn of the 3 low risk, high interest assets that can generate passive income for you, then why not look at my my earlier video on this, where I go through further details on such passive income instruments.